Welcome back. This is Mike Vitagliano, and this is episode three of the Startup Evangelist Investor Red Flags. I wanted to bring these concepts right to the very front of the content that I shared with you, um, simply because how investors perceive the co-founders is such a critical aspect of becoming one of the 10 to get funded versus the 990 that get sent home to try again, as we discussed in the last episode. So, with that said, I'll make some fairly broad statements. And I also recognize that each investor is a separate individual with their own preferences and opinions. But just be aware that these are the kinds of issues that they look for when they're reviewing a pitch deck or meeting with a founding team. So let's get right to the content. So this might seem a little disingenuous from me, since I was a very early stage acquisition. But investors are really looking for IPO candidates. As we saw in as we discussed in the previous presentation, episode two, 55% of the investments that they make are going to fail. What I didn't cover is that a smaller percentage is going to be acquisitions where the investors really don't meet their investing goals. They've raised money from outside institutions, and they've committed a certain return on that invested capital. So for the VC to meet their business goals, they really are looking for IPO candidates. And if you happen to be a venture that gets, acquired after product market fit, but before an IPO for billions of dollars, more power to you. The real issue is really going to be what's your TAM, and I will discuss TAM in much more detail in later stages. But TAM stands for total addressable market. Are you proposing a solution, a $50,000 solution that could potentially be used by every small and medium-sized business in the world? Are you proposing a $100,000 solution that could be utilized for every enterprise in the world that has more than 1,000 employees, both businesses and government? Are you proposing a consumer solution that is going to cost $30, but could be used by everybody that has a personal computer, a new antivirus solution? So your mix here of your solution and your TAM are really the presentation that you're making to the investor to justify why you are going to be a candidate for an IPO at some point down the road. Now, you don't need to, you know, challenge the investor and say, I'm going to be an IPO and there's, no way I'm going to fail. It's just your goal. It's an unsaid goal. It's an unstated goal. They're looking for IPO candidates. You want to be one. You have to prove it. To the next bullet. Asking a VC for an NDA is a sign of management immaturity. Um, they're not going to sign one. This particular bullet is covered by the golden rule. Those that have the gold make the rules. And the reason they're not going to sign it is everybody hates going to court, whether you're a founder or a venture capitalist, and paying legal fees. So they will avoid them like the plague. An NDA is a legally binding document. They may be looking at four or five companies in a particular, or four or five new venture teams in a particular market segment, and they, choose only one to invest in, and the other four go away. And then they see that the investor has invested in a team, and the founders of the four that have weren't selected for funding feel that their ideas have been consumed by the team that got the money. And if a VC signed an NDA, they could potentially be subject to a lawsuit. They're not going to sign it. Don't ask. You need an NDAs with, early stage employees, but you're not going to get one from a VC. As you make your presentation, do not attempt to boil the ocean. Do not overhype the solution. I had, one founding team, very interesting software solution, and they made the comment that it was going to change the world. And I laughed almost hysterically. And I looked at them and said, guys, you're building a nice piece of software. The world isn't going to change. And so overhyping the significance of your solution is a sign of management immaturity, not management maturity. So again, be cognizant of this and recognize that you are building a very specific solution with a very obvious target account market that can make money for people. And don't overhype the solution's impact. If, on the other hand, you have a solution, if you're going to create the next generation wheel and you really are going to change human society for all to see, then don't be afraid to tell the people. But if you're going to do that, it's probably going to be pretty obvious to all involved. Um, you have to have a competitive analysis and market validation for your solution. Just turning around to an investor and saying, we've come up with this idea. We haven't really looked at what anybody else has done, and we haven't really talked to anybody who's in the marketplace who would be a candidate to buy our solution is just a losing argument. So make sure that you've got a competitive analysis and market validation. Otherwise, again, red flag. No financial projections or lack of details. And what do I mean by that? When I built my business plan, it was called a business plan back in my days in the 90s and not a pitch deck. But I had to present a 3-year financial analysis by expense category by month and had to build a really extensive Excel model to show how this business was going to spend money over time, what I was going to use the money for from the initial investment, how I was going to need subsequent investments down the road. But financial details or projections really are very significant. It again is a sign of management maturity. And if you show really high founder salaries, let's say, for example, you're a very highly paid cybersecurity expert, and these days, there are individuals being paid in the hundreds of thousands of dollars, multiple hundreds of thousands of dollars, or you're an AI expert, another example where people are talking about, $100 million compensation packages for AI experts. And you want to pay yourself that amount of money because you don't want to take any financial risk in starting this venture. They're going to question those spending plans as to, are you really committed to the venture, or should you, more than likely stay with your existing job and have minimal risk to your financial standing. There's also, it's often the case that you may have had earlier rounds of financing before you get to a venture capitalist. You may have had a family and friends around, or you may have had angel investors. And again, I will have a video talking about all the different types of investment rounds and individuals and organizations that you can go to. But if you have different terms per investor in these earlier rounds, it just it shows a lack of trust in your partnership with these investors. So for each round, I really suggest you have the same set of terms, the same, purchase price for the stock that the investors are buying, and treat everybody equally. One of the biggest red flags is if, again, from a first-time founder perspective, you have family or romantic relationships as a part of the co-founders. Again, it's a sign of management immaturity. If you're Elon Musk, it's a very different thing when you're proposing a new venture than if you're the, brand new college graduate that wants to build this brand new venture and brand new solution. This is something that catches a lot of individuals, uh, or it surprises a lot of individuals when an investor does their due diligence. They're going to look at your personal life as well as your professional life. Um, you know, is your personal life littered with DUIs and arrests? Are your social media platforms littered with political rants, homophobic rants, really inappropriate communication? You're going to be judged on your personal life as well as your professional life, and it's again, a suggestion would be to, if you have challenges in your personal life, you either scrub your social media platforms, or not either, you scrub your social media platforms and you come clean with your professional or personal indiscretions that are going to be out there that somebody's going to find. I mean, everybody does a background check today and everything shows up. Getting back to the business side of it, if you have questionable intellectual property ownership claims as a part of your technology stack, um, you really have to be able to, if you're going to be using a lot of open source software, you have to make sure that you can use it in your technology stack that you're going to sell. So that means understanding for each open source solution what licensing terms are appropriate, or have been assigned to each open source solution, and being able to convince the investor that you have complete and total ownership to the intellectual property. Now, a little aside here, excuse me, a little aside here, with so many new solutions being generated through AI, or will be in the near term. I certainly haven't seen any um, legal decisions that have said who owns that intellectual property. Is it owned by the individual? Is it owned by the company that built the AI tool that generated it? You want to make sure you're reading the terms and conditions of any of these outside solutions that you may be using in the creation of your intellectual property. Weak technical depth. This is another one that I try to get across to the founding teams that I'm talking with now. If you're saying that AI functionality is a key to the solution, but the co-founders do not have any real world AI competency, what you're really saying is, give us the money and we'll go out and find somebody who can build this solution to our specifications. Um, some investors may look at that sideways and say, go find the expert, make them a part of the co-founder team, and then come back to me. But that weak technical depth is something that um, shows up very quickly in the discussion with outside investors. I addressed this in episode 2, but co-founders that are not critical to the solution at that specific stage. Having a salesperson as a co-founder when you're going to spend the next 9 months building a solution is not going to go over well. Having a human resource person as a co-founder at the early stages of building the solution is not going to be seen favorably. So you have to prepare for that and make sure that the people you are bringing into the fold, so to speak, to be a co-founder with this new venture are going to be able to contribute right away. I've seen this many times where co-founders get in front of an investor, get in front of investors to make their presentation, and they start arguing with one another. They talk over one another. So that conflict is, a sign of, again, management immaturity or co-founders that are unprepared. They go into the meeting and they don't have a financial model that shows, they're asking for $600,000, but they have no financial model that shows how they're going to use the capital. Um, Again, management maturity or immaturity is a big investor red flag. Co-founders that are unprepared for the challenge, they just, they have no idea at all how to go and build the company that's going to support the solution. Co-founders that don't understand the sales challenge, they make statements that, we're going to build this and large enterprises are just going to consume it without any problem whatsoever at $150,000 for annual or recurring revenue. Red flags all around with that kind of those kinds of statements. Excuse me. Co-founders that are not perceived as coachable, that are stubborn in their discussions with investors. That many times an investor will, you know, throw out a concept just to see if you're coachable, just to see how you're going to react to it, just to have that give and take conversation. And if you're not perceived as coachable, you know, you're probably not going to be somebody that the investor wants to create a partnership with. And last but not least, co-founders that present a very complicated deal structure. The deal structure has to be a win-win for everybody. And I'm not going to go into term sheet concepts at this point in time, but you have a deal, you have a pre-money valuation, you have an amount of money that you're looking for, and you have a post-money valuation, and now you let the lawyers get together and they start working out the terms and conditions of it. Um, that's the kind of simplistic deal structure that will not raise the red flag for the investor. So thanks again for your time. This episode, as was obvious, was about investor red flags. The next episode is how investors evaluate startups, what they look for, what they look at. So thanks for spending your time with me. Bye now.